Hey everyone, welcome back to Corporate Decoder. This time we're diving into Pioneer Bancorp's latest filing, and trust me, it's juicier than a bank heist movie. Without the actual heist, hopefully. Pioneer, like a lot of regional banks, has had a roller coaster of a year, so let's see what's been going on behind those brick walls. First off, this isn't your typical year-end report. It's a transition report because Pioneer changed its fiscal year to end in December instead of June. So we're looking at 6 months of numbers instead of the usual 12. Keep that in mind as we decode the data, comparing 6 months to 6 months, a year to a year. Let's talk about what Pioneer Bancorp actually does. They operate Pioneer Bank, which has a bunch of branches in New York's capital region. They take deposits and give out loans. Commercial real estate, business loans, home equity lines, the works. Think of them as a community bank that also sells insurance and offers wealth management services, hoping to be more than just a bank so they can be your one-stop money shop. The report says the value of their publicly held stock was around tender offers wealth management $7, wealth management $7 loaned, commercial real estate, business loans, home equity lines. The works. Think of them as a community bank that also sells insurance and offers wealth management services, hoping to be more than just a bank so they can be your one-stop money shop. The report says the value of their publicly held stock was around $107.77 million last June, and as of March, they had about 25.8 million shares floating around. Now let's get into the meat of it, their lending. Pioneer is mainly in commercial real estate, but they also do a good bit of residential mortgages. They've got this partnership with Homestead Funding to handle the whole mortgage origination process, which is pretty interesting. Looking at the loan portfolio, commercial real estate makes up a big chunk, around 28.5%, with a heavy focus on multifamily properties. This sector can be riskier, so how they manage it is super important. We will need to look at it in asset quality sections. Another thing to notice is how they are still offering home equity products that some institutions are pulling back from. This product makes up another 6.5% of their assets. These loans and lines of credit are secured by homes, and they're a way for homeowners to tap into the equity they've built up. Pioneer isn't just lending out their own money. They're also buying loan participations. It says here they bought a bunch of consumer loans from BHG Financial, and they plan to keep doing that in 2025. Basically, they're buying pieces of loans that other institutions have already made. Now, who's calling the shots on these loans? For smaller loans, it's usually a commercial officer. But for the big stuff, like commercial real estate over $7.5 million, it has to go to the board of directors. The big takeaway is that a few bad calls on big loans could hurt the entire company. Let's talk about the scary part, asset quality. They have a bunch of loans that are past due. We can see the loans that were 59 days past due almost quintupled to $7.9 million, thanks to a troubled $4,007 million, thanks to a troubled $4.7 million commercial real estate loan relationship. You don't want to see those delinquencies climbing. We can also see that non-accrual loans decreased, mainly related to payments received from the borrower. This was offset in prior periods by several loan relationships upgrading out of the category. Regulators keep a close watch on banks and classify their assets based on risk. Substandard loans are those with weaknesses that could lead to losses, and those increased a bit. Special mention loans, which need extra attention, decreased by a substantial amount. The biggest reason for this was because some of them were in the substandard category previously. In total, it seems they are downgrading some loans but upgrading others. This means that there was some volatility in their portfolio, but not too severe to make the situation unrecoverable. To prepare for potential defaults, Pioneer sets aside an allowance for credit losses as a percentage of total loans. This allowance decreased slightly since June, landing at 149%. It's a balancing act. Too little and they're exposed. Too much and it impacts their profitability. Moving on to investments. Pioneer's strategy is pretty conservative. Mostly US Treasury notes and other government-backed securities, with some municipal and corporate bonds thrown in. At the end of transition period, a large percentage of their portfolio is in US Treasury and municipal obligations, making it very safe and reliable, but not very profitable. Also, note this large fair value decrease from their held to maturity securities portfolio. Deposits are the lifeblood of any bank. We need to see how Pioneer attracts and holds onto those funds. Looking at the numbers, their biggest depositors are retail customers, but they've also got a good chunk from businesses and municipalities. These government deposits are important, but often price sensitive. Speaking of deposits, a key metric is how much is uninsured. That's the money above the FDIC insurance limit of $250,000. After you remove affiliated deposits, that number is 200 and of 4 tall deposits. This could cause less liquidity in the long run. To shore up their funding, Pioneer also borrows money mainly from the Federal Home Loan Bank of New York. They had about $40 million borrowed and $150 million used as a guarantee, which is a safety net, but also an expense. Let's step outside the bank for a moment. Pioneer also has an insurance business that sells commercial and consumer insurance. They also have a wealth management business, Pioneer Financial Services, which manages $1.2 billion in assets. These arms diversify Pioneer's income and make them more than a bank, as they say. As of the end of last year, they have 272 employees. Management feels that they are having good working relations with them. Banks live and die by their regulatory ratios. Pioneer is considered well capitalized, which is good. It means they've got a cushion in case things go south. At 18.85%, Common Equity Tier 1 risk-based capital is definitely something to be proud of. They had a few key accounting changes. The most important is an adjustment to the way they calculate credit losses on financial instruments. Every company has risks, and Pioneer lays them out in detail. They've got a bunch of outstanding legal cases and potential fraud and compliance problems. These are costly distractions, and bad outcomes could really hurt their financials and reputation, as we've seen in their balance sheet. Don't forget the usual suspects: economic downturns, political instability, cyber attacks, but they also highlight something interesting: climate change, which could mess with property values securing their loans. Now, what to make of all this? Pioneer is trying to strike a balance. They're focusing on commercial lending to boost income while diversifying with insurance and wealth management, growing their balance sheet and increasing efficiency, but they're also navigating a tricky interest rate environment and potential credit quality issues. Pioneer Bancorp seems to be in a stable position, but facing clear headwinds related to interest rates and some past decisions. What do you think? Let me know in the comments, and don't forget to like and subscribe for more Corporate Decoder, and I'll see you next time.